It looks like we have quite a few that have joined us, and so we should have a few more here in the next few minutes, but I will get started. My name is Jen Hicks. I'm our Director of Client Development here at the firm. I will be moderating the event and posing questions to our panelists. I just want to thank everybody again, including our speakers, for joining us today. Just a couple of notes. We will have a Q&A at the later half of the webcast. So there is a Q&A. If you are logged in to the URL, you can answer or ask some questions. We will be monitoring that, and then we will be presenting those to the speakers during the later half of the event. I just want to get started. You know, we've been discussing what's going on, and the reason that we wanted to have this webcast and invite our speakers is really to give us some of their insights, both from a fund manager perspective as well as investor related, and answer the questions that our firm has been getting, as well as some of our speakers that have been receiving from some of their clients and their network. I'm going to start off just a brief introduction of our panelists. I'm not going to take too long. We're going to have a follow-up email sent out that will have all of their information if you do want to contact them. But I want to get into the questions and what this event is for as soon as we can. We have with us our managing partner, John Lohr. He's been advising fund managers throughout the US, Europe, Middle East, and globally in forming and operating various types of funds, real estate, hedge, private equity, and other alternative funds using varied strategies. John, as many of you know, is often called upon to speak at investment management events in the US and Europe. We've done several of our own events, and he's provided a lot of his insight and guidance through the years. We also have with us Paul Grassi. He's with Alliant Insurance Services. Paul is the Senior Vice President at Alliant and is the primary relationship manager for his clients in the financial institution sector. They focus on hedge funds, private equity funds, 40 Act funds, and registered asset managers, broker-dealers, as well as others. Prior to this, he was a Senior Vice President and Sales Executive Manager for a nationally ranked insurance brokerage. We've known Paul for a while now, and we like having him join our events. We also have Nancy Vailakis. She's on the line. She is from IQEQ. She's based in their New York office and is their business development director covering the Americas. IQEQ offers international and domestic service offerings, including, but there's several others that I won't list off at the moment. Portfolio monitoring, fund administration. They focus on emerging and middle market, private equity, venture capital, real estate, and infrastructure strategies. Nancy speaks at many events. She travels quite frequently, or has in the past, speaking across the nation and globally. At events. Prior to IQEQ, she was the Vice President of Investor Relations at a capital management firm where she covered the commingled institutional funds and fundraises with senior partners at the firm. So it's really great to have her and her perspective from the fund management side. And then we have Oliver Bell. We've worked with Oliver for many years at Walker's. He's at Walker's now in the Cayman Islands office. He's been doing legal work and law in the Cayman for quite a while. He's the partner there in the Global Investment Funds Group. Oliver advises on many aspects of investment funds law, including pre-formation strategy, organizational structure, and regulatory compliance for private equity and hedge funds. And last but not least, we have Arthur Bavelas. He is the founder of Bavelas Group Family Office, as well as Family Office Insights, which was one of the first private opportunity review networks for investors. He has several other ventures that he does. So those will be listed in the follow-up email. But Arthur's a published author, He's called upon by several publications to speak. He speaks on wealth preservation, entrepreneurship, investing, and he really focused in on creating a great network for family offices to have updates and insights. So we really appreciate him being here from that perspective. And with that, I want to just let John say a few words on the event, the focus of the event, and then we'll lead into touching base on the domestic legal perspective as well as the offshore from Oliver.
To each of the speakers, and thank you for taking the time to. Yes, thank you to you, Jen, and to the panelists, and to each of you for joining us and dialing in. This is a unique presentation for us because we're talking about a subject of which the parameters are uncertain and the consequences are high, and we are looking at questions that we are seeing from fund managers relating primarily to their interactions with investors and ways that they can prepare for future uncertainty. In our discussions, that managers are looking at the concerns that investors have first, and secondarily, looking at how they can protect themselves. And I think that's in line with the general philosophy. I see a distinction between this round and previous financial downturns, in that people are in the same boat. There's a high degree of collaboration, and this discussion is really centered on looking at how we can take investor concerns and join them with the protection of fund managers.
Perfect, thank you. And along the lines of what we do at Capital Fund Law Group and those that we serve, including all of our fund manager clients, if you could just touch base on what you're seeing from the legal perspective here in the U.S. and what fund managers may want to be, prepared for, or staying up to date on.
Sure. Yeah. So the good thing so far is we haven't seen a triggering of gates. We haven't seen a mass exodus. There's certainly different funds and different perspectives, and we're preparing for the worst and looking for ways to navigate that. But in terms of current investors, there's been a heavy focus recently on private equity. The hedge side has already experienced a tapering such that the current investor side on the hedge funds haven't necessarily seen the mass exodus yet that we experienced in 2008 to 2010. Of course, with capital raising, that is the area that is directly and significantly impacted, and that's an area that there's the greatest concern moving forward, because from a legal perspective, those are the the areas of greatest potential risk, both current investors that may either subscribe additionally or be induced to continue to hold their investment. This is a time when, from a legal perspective, the greatest care needs to be taken. But right now, the watchword is uncertainty, and that's affected the paradigm of the investors.
Right.
John, it's Oliver. It's Oliver here. Can I just add very quickly that I absolutely agree on the offshore side as well. We're just not seeing the levels of redemptions that we saw back in 2008, which is a good thing at the moment. I had a chat with a friend of mine who's an audit partner at Deloitte this morning, actually, on this very point, and he said from his perspective, it's business as usual. Yes, they're putting in subsequent disclosures into the rep letters, but actually their clients are weathering this well. And yes, we are seeing some distressed fund situations, both on the open and closed-ended fund side on the offshore piece, but frankly not at the levels that we saw back in 2008. I just wanted to add that.
Perfect. And for John and Oliver, John, I'll let you touch base first. Just for the managers, what questions do they need to be asking their legal counsel? What should they be working with their legal counsel on, potentially in terms of their offering documents or how things are set up? Is there anything they should be doing in particular at this time?
Sure. So with current funds that have existing subscriptions, especially when they're hedge funds, open-end structures that are permitting redemptions, there should certainly be a review of the disclosures. But one thing that we noticed in the financial crisis is that managers were quick to focus on risk factors, focus on providing information about the financial crisis, and that's helpful. But at that point, it's a known and visible risk, and so the focus on the offering documents now should be on informing investors about any changes to their investment strategy that might result from the changes. And the best pragmatic approach there is to initially have discussions with the management team and legal counsel and engage investors directly, providing updates via documentation and letters and meetings is all part of both the manager protection, but more critically, the investor engagement and full disclosure of the manager's activities. And of course, portfolios are going to be affected, and that's going to implicitly affect the strategy. But the real issue is what are managers doing to protect their investors, and how is that conveyed to investors, and how is that documented, and then of course traced through compliance, because what's happened previously is not affecting investor decisions from a legal perspective, but the way that managers deal with the the current climate and their investment strategy change is what will have legal consequence.
Okay. And Oliver, for you, the same question is, what questions should they be asking, your firm, what should they be doing, and really just an overall sense of what you're seeing, not only from,
Sure.
the Cayman government's response, but also, SEMA and any changes that have come about
Sure.
from all of this. Thank you.
And on the risk factor side, it's very interesting. John, I don't know about you, but I've seen plenty of COVID-19 risk factors bounded about now. It's interesting. I'd say about 50% of our clients are adding them, but the other 50% are holding tight and not adding them. So it's interesting on that one. I'd say now is the time more than ever, if you haven't already done so, to review the offering documents. I mean, the OM, M&A, subdocs, and indeed any side letters that you've got as well, to see what powers you have available to ensure that the fund remains as a going concern. Now, I'm talking about suspensions of redemptions, suspensions of NAV calculations, gating, the ability to side pocket, etc. The difference between now and 2008 is back in 2008, funds didn't generally have these powers available to them. Since 2008, we as lawyers have, and John, you'll agree with me on this, and I'm sure, we have been avidly putting these provisions in to protect the managers and the funds going forward. So unlike in 2008, it's not a question of whether you've got those powers. The issue now is really whether you activate them early enough. The point to note is that once you actually receive the redemption request, it's often too late to do anything about it. So now is the time to review everything with your lawyers to make sure that all your ducks are in a row for if the worst case actually happens. John, I don't know if you've got anything else to add on that point before I go on to what the Cayman Islands government is doing on this side.
No, please do.
And by the way, before I go on to this point, I wanted to also thank you and Jen very much for setting this up. You've done a splendid job in very difficult circumstances, and I know you're an incredibly innovative firm, and when it comes to helping clients like this, you are at the kind of the forefront. So thank you so much again for including me. It's interesting. I look out of my window and I'm on the 7th floor of the tallest office building in Cayman. So 7 stories is obviously nothing compared to offices in New York, but from here I've got a pretty good view of the airport and the runway over here. And my associate is an avid plane spotter. So he'll run to the window 100 times a day and tick off the latest AA or BA flight that's arriving or landing. The interesting thing at the moment is that we had our last flight leave the island yesterday at 9:15. That was a BA flight, and it was full of effectively people now who currently don't have a job for the next few weeks in the hospitality sector. We are now, as an island, self-isolating. No people are allowed to come in or out of the island by either sea or air for the next few weeks. And all of the restaurants, bars, hotels on island have all shut at the moment as well. So the point really is that the Cayman Islands government is taking this incredibly seriously. On the financial services side, we are receiving, as you'd hope, regular updates from all of the various departments. And I'll just go through those one by one because I think these are quite important. So the Ministry of Financial Services now they've sent an update recently to say that they are working as usual under a business continuity plan, but are continuing to work towards international deadlines. The key there, from a Cayman Funds perspective, is that they are working towards removing the Cayman Islands from the list of EU non-cooperative jurisdictions, otherwise known as the blacklist. And that deadline we're hoping to be removed by October, and that's what they're still working hard towards. The Registry of Companies is continuing to operate, so you can still make filings, etc., over here, and you can still incorporate, etc., over here. They've made a few filing extensions for certain changes, but nothing major on that front. The Department for International Tax Cooperation, which deals with FATCA and CRS, has said it's business as usual, albeit under business continuity hours and planning. And then last but obviously not least is SEMA. Now, SEMA is working as usual. They are working on a shift pattern, is my understanding, and usual hours, say for on a couple of days a week when they finish at 2 in the office, because they are obviously having the office sterilized on a regular basis. Now, when it comes to things that they may be doing to offer funds leeway at the moment and extensions, SEMA actually hasn't done anything. But I can understand their position, because what we'd be talking about here is really extensions to audit filing deadlines. Now, when I spoke with the audit partner at Deloitte this morning, he said that frankly, from their perspective, all of the audits are going ahead as usual, so they don't actually need any extensions at the moment. But, you know, they're in a wait-and-see pattern to see if anything changes on that front. The one thing I did want to mention, though, which I think is pertinent, is that on the private fund side and the current 4.4 exempt fund side, there is obviously now, or there has been changes over in the Cayman Islands to the legislation to make sure that very soon all private funds, so closed-ended funds, and current 4.4 exempt funds will need to register with SEMA. Now, the current deadline is the 7th of August, but it may be that deadline is pushed back given what's going on at the moment. So we're waiting to see what happens on that front, and we're waiting for proposals from SEMA, but nothing more to report.
Okay, thank you. And that's good to hear that, you know, the government and SEMA are both, you know, working and coordinating and taking action as needed and staying up to date. And like you mentioned, I think it's heartbreaking for all of us to hear those that are, you know, temporarily out of work, especially in the hospitality and service industry. And I think that kind of leads into the investor communication side, where I was having a conversation the other day, and when you see some emails that come through that are you know, salesy or whatever it might be, it just kind of seems almost off-putting because of the suffering that's going on. And so to lead into that, it's, you know, we have these fund managers that need to be having these conversations, but I feel like they need to be done, you know, in maybe a specific or a certain way, or, you know, with an extra layer of care going into it. And Nancy, I wanted to loop you into the conversation and just ask, you know,
Sure.
what I see, and I've read and I've spoke with managers that are trying to hold weekly, sometimes even daily meetings to help ease these concerns, to help boost their communication. In that regard, how frequently, you know, from your experience working with your prior firm and now, how should managers be reaching out to investors, and what do you feel that they should be including in these communications that investors want to see?
Sure. You know, thanks once again, Jen and John, for the thought leadership here. Certainly the Capital Fund Law Group is jumping out in front and trying to provide suggestions to the GP and LP community, and I'm quite impressed with how quickly you guys are moving forward to provide that advice. To come back to your question, Jen, you know, obviously during these unprecedented times, the GP community needs to communicate more succinctly with LPs, leaning very heavily on their counsel. Indeed, there are many investors that have side letters in place that enable them to receive a certain kind of reporting. But indeed, your LP community wants to know that you are looping in all LPs as equally as you can. And indeed, you know, it could be daily calls, it could be weekly calls, it could be monthly calls, but each investor is different. And indeed, every type of investor is different. With respect to public pension plans, you know, they're intent on understanding what's going on so they can report to their constituents and the underlying retirement community that they serve. And indeed, they're trustees. And in some cases, with respect to public pension plan investment professionals rather, they're reporting into people that don't quite understand the markets, and they might be calling up and saying things like, oh gosh, when is it going to go down? Of course, the markets are their own thing, and you know, when is it going to go down or when is it going to go up? I think that's, you know, people pretend to have a crystal ball on that front. Generally, I think that's a lot of bluster. Indeed, I think what LPs are looking for right now is increased communication, but sober, calm, sensitive leadership. a number of us on this call, probably all of us, have been through downturns before. I personally worked for a credit fund when Lehman fell. I also worked for an M&A banking entity when the tech bubble burst. Each one of these downturns is very different. And indeed, this is the first time that most of us, perhaps some of us have dealt with this, but I severely doubt it, that we have dealt with a global pandemic and indeed a quieting of most of the kind of general flow of economic activity. And so we don't really know where this is going in full. And so I think blustery, salesy communications that try to give comfort when it's not really warranted or appropriate lose more than they gain. It's more important, I think, for people to give a clear picture of what they see. Indeed, there are distressed firms or firms that are dependent on volatility to make their gains that can gain during difficult times like this. But given that, according to Alan Greenspan, we are now actually, solidly plunged into a recession as of March in the U.S., and about 100 people are being asked to stay. 100 million people, rather, in the U.S. are being asked to stay home. I think the calls with investors have to be sober and show leadership, and also show a kind of a calm process orientation toward what is coming through to us through the media and what is coming through to us due to the market cycle. So I don't think there's an answer as to how much you should communicate or exactly what you should say. It really depends on your counsel's steer on this, and also what you're seeing in the markets given what you're invested in as a GP. But indeed, there's light at the end of the tunnel in that there are many businesses that emerge from downturns to go ahead and succeed in businesses that people didn't foresee. So there's always a silver lining in that there's opportunity in risk, but to emphasize that too heavily would certainly be crass and insensitive, as you pointed out, Jen.
Right, and I agree that there does need to be that balance. And along those same lines, for Arthur, I am curious, how you're seeing from the family office perspective. How are they reacting? What are the thoughts in that community on, communications, or really what is their response to the current climate?
Hi, thank you. Hi, everybody. If you don't mind, I'm going to answer anecdotally in that I'm an investor in private equity, hedge funds, and a variety of other investments where I'm an LP. And if you don't mind, I'll share anecdotally what's been interesting and helpful to me, and then I'll give a little comment on what others are telling me in the community. The thing that's been most helpful, and I will use the word comforting, is communication to me as an LP from managers that discuss on whatever level it happened to be that they were prepared, although we clearly can't be prepared for this sort of thing. And then what are they doing in the interim as they learn things to not only adjust perhaps their investment strategy, but from a operational perspective. Whether you're invested in a hedge fund that invests in public equities or a private equity company that invests in private companies, the domino effect of how it's affecting those companies is super unclear, but it's not good. And so what is often communicated is just take your time, don't get emotional, don't liquidate. And I think that that's probably sound advice depending on your situation. But what I really found helpful to me was the clarity on what had been done, whatever it had been done in terms of being prepared, and then what they were doing presently as they learn things that are just unknowables up to this point. Just wanted to share that from an anecdotal personal perspective. The community family office community is not one that you can generally make general statements about. accept that they don't have to do anything they don't want to do. And so the tendency from the people that I've spoke to and heard some feedback, and as you know, we did a little webinar also around COVID-19, more about the medical stuff, but we got a lot of feedback on that, is that people are dismissing any communication that is suggestive of a promotion or a sale, or it just seems to be so irrelevant. So it's rubbing people the wrong way. So again, this may not be a very comforting thing for managers to hear, but it's in the throes of something which is seemingly as serious as this. It just seems trivial to talk about, investing in a new fund and that sort of thing. And I'm not saying that's going on, but I just, by way of example, the sentiment is hopeful in terms of what's going on with coronavirus, but it's gotten a big shove into serious based on what we've seen in other parts of the world. So I don't know if that's helpful, but that's at least from that perspective, what we're seeing in the community.
Absolutely. And I think that even in just the last week, the increased concern has really gained traction, rightfully so. I would just open that for the other three panelists, if you have anything to add along those lines of what you're seeing from investors, the questions that they're asking, things that they want to know. Okay. If we don't have anything on that, anything further, I would go on to even pose this. Nancy, I'll pose it to you first, but then I'd like to open it up to others, because I think this is a question that people don't want to ask, people don't want to receive, but it is a true difficult conversation that managers and investors are having, that the investor wants to get out. And I think that maybe fund managers, especially emerging, don't know how to approach this conversation in the most practical and honest way to have that open dialogue with that investor. And Nancy, I just posed to you what maybe you think would be an appropriate way for both an investor and manager to have that conversation.
Yeah, sure. I'll jump in on this one, Jen. Thanks for directing it to me. There's an awful lot more. There are many, many more institutional investors that have more money locked up for a long-term cycle this go around. The quarterly liquidity hedge fund is still out there, of course, but as the lawyers on the call pointed out, there are many more stipulations around potential gating and protections for GPs this go around as well. But there's an unprecedented amount of money in private markets and invested for 10 years plus one, or perhaps there are of course a number of hybrid strategies that have different lockup terms, but the quarterly liquidity question is less prevalent this go around. But there is an institutional investor rebalancing at the end of this month that's quite substantial, that may shift some of these conversations. I think, if an investor wants out but they're locked up for 10 years, obviously, counsel is required for such a conversation. If it's quarterly liquidity, that's a different story. Obviously, you want to try to compel investors about the long-term opportunity set, but sometimes that's hard to do when there's been a real decrease in paper losses, which are not just paper losses when they've been as substantial as this. I think just keeping people calm and trying to kind of iterate the investment thesis without being too salesy. Indeed, pointing out that a lot of people did well the last go around by buying up the cheap stuff when everyone was afraid. But I think even that conversation is probably a little early for now, because we're still seeing where everything is going. I think honest assessments about and reports about the actual performance in the book, and honest assessments about strategies for dealing with uncertainty which is really what leadership is about, frankly, because putting together a plan that only works during the good times isn't a real plan because life is uncertain. So, showing your investor base that you are the leader that can bring them out of the woods, perhaps by simply being sensitive during this time, or, by kind of rolling with the needs of each individual investor to an extent, trying to get them what they need is the best way to tackle this.
Perfect. Thank you. And do any of the other panelists have any additional thoughts to add?
Hi, this is Paul.
Sorry, Paul. You go first.
No, thank you. Thank you. Just a real quick note. Obviously, on the insurance front, from an E&O, D&O perspective, carriers are very sensitive to any kind of communications that convey any expectation that may or may not come to fruition, based on the market and performance and things of that nature. So, agreeing totally with what Nancy and the others have been saying about, caution in your communications with the LPs is definitely critical from all facets.
It's Oliver here. I was just going to say, urban legend has it that a very large fund manager, I won't name them, but a very large fund manager back in 2008 didn't have a single redemption because they had a huge team of investor relations people who were reaching out regularly with their investor base saying, don't redeem, these are the followings, why not, this is what we're doing, etc. So, transparency and very frequent communication is key here. But on the flip side of that, I think you need to think twice about giving one or a small group of investors a heads up here. What you don't want to allow is investors to have privileged information which allows them to jump the gun, and suddenly you get a redemption request from them, and then everyone else is left in a sinking ship, because that will not end well for you. So think carefully before you give information to individual investors.
Yeah, and I'm just going to add one more thing there, is to make sure you have a tracing mechanism in place so that investor communications are being tracked, they're being screened for content when needed, have legal counsel look at that. Ideally, you have a specific communications protocol for these types of events, and have that traced both at the management level and at the IT level, so that you have a clear record of each communication. There's a misconception that the offering documents themselves form the last word on disclosure. Every disclosure that's made, whether in the form of a pitch deck early on to monthly account statements to investor casual communications, although they may have a different context and a different expected level of semantic weight, they have equal authority when it comes to a communication, both from a disclosure perspective with potential misleading statements, or from a preferential and parity perspective. And so having that unified, controlled vocabulary, controlled assertions, and being able to track that, review that, incorporate that into your compliance is critical, especially now.
Thank you. Yes, and
Jen,
yes.
if I may, Arthur here. I don't know how one does this legally, and what John just said is super interesting. I hadn't really thought about it in the terms, even though I've regularly said disclosure is king. I hadn't really thought about it in the terms of that everything's a disclosure when it comes from a compliance perspective. And that would also suggest that I'm a little swashbuckling with my communication, but I'm not subject to compliance, so there you go. But I was wondering how one would incorporate believable empathy in a communication that's thoughtful about what's going on now, because it feels kind of like 9/11 in that we're all in this together and it's just surreal. And when I've read things from people on the fund side and so forth that have believable empathy as opposed to vapid, not believable empathy, it would it sells. I think it would, at least from an investor's perspective, with the proper disclosures, I guess, and so forth. I think that's helpful. So just a comment.
Yeah, and I think that's something.
If I may.
Oh,
go ahead, Jen. Pardon me.
No, you're fine. I was just going to touch on it, and feel free after this. I think that's a good point to bring up is in communications, and like John mentioned, and staying consistent and compliant. And we'll discuss more here in a little bit on really having that plan in place. How do you have a genuine, which I don't think we have one client at our firm that isn't compassionate and concerned with what is going on in this situation, but they do need to stay compliant and stay consistent across the board. And that's a hard balance, I think, to strike.
I saw an amazing investor letter come through this morning from the Rock Creek Group in Washington, D.C., Cindy Bavelas' firm. Basically, this is an economic report that is perfectly sober in terms of what's going on and perfectly sober in terms of where the opportunities may lie and what they're doing. I think, honestly, every firm has a different style, and indeed the leaders of each firm approach things differently. Not everyone is Howard Marks, who's quite famous for being a good communicator in times of trial. But this letter was extremely impressive. Honestly, this is a smart firm that is trying its best to give investors intel that they have been monitoring as they've looked at the crisis that has ensued this month, and they're being extremely direct about what's going on and where the opportunity may lie, but they're also saying, gosh, here are the unknowns. So, I think leading with intellect, leading with sober, calm assessments, given that those assessments will probably change as the facts change, is really what LPs are looking for, and indeed is what is needed right now.
Right, absolutely. And I know this is an important topic to touch on, so if any other speakers have thoughts. Well, I think that then segues a little bit more into, and still keeping communications in mind, and we'll touch base on that. But Paul, just from your perspective, because I know Alliant does a lot of risk and cyber and insurance, and from where you stand, what are you seeing in terms of, or what do you think the importance needs to be for that internal contingency plan, or even just having that plan in place for a lot of people that didn't weather the storm, like, I believe probably all of our panelists went through in 2008. This is their first huge international crisis. What type of plan are you seeing, and what should they be doing?
Well, thank you. Again, as the other panelists had said, this is a tremendous forum, and we appreciate John and Jen and the Capital Law Group for bringing it out. It strikes me that the contingency programs that have been put in place in the last, say, 5 or 10 years have really dealt with primarily technology-related breakdowns, breaches, data, cyber criminals, and things of that nature. I think this is a new kind of sphere that we're in, where a fund could potentially find itself with, VPM or VPMs being sidelined because of a sickness, something like a pandemic or an epidemic like this. So maybe fund contingency plans going forward have to have prearranged sub-advisor relationships with other funds or other PMs that might be able to step in this kind of a catastrophic situation where, by virtue of the fact that the portfolio manager is unable to transact business, the fund suffers, and perhaps there's some planning that goes into arrangements with friendly firms or friendly registered investment advisors that could step in if there was a need, such as, this broad kind of pandemic that we find ourselves in.
That's an interesting perspective to touch on, and I agree. And I'd love to hear, Oliver and John as well, thoughts on when it comes to the operations side, funds that are ramping up and gearing up to launch, and those that, already are. What, in terms of their planning, their operations, compliance, what should they be doing and preparing for and putting into place?
John, do you want to go first? I think we're currently seeing, it's interesting, we saw a bit of a lull talking about just fund launches generally. We saw a bit of a lull a few weeks ago, but now actually we've seen a huge uptick again. And my suspicion is that is simply to take advantage of the market volatility that's going on at the moment. So not just emerging managers coming out of the woodwork who have been waiting for some time, but also new funds being launched by existing large fund managers. And I think that's a really positive thing as well. I've got a number of clients who at the moment, their performance is, they're doing incredibly well on the hedge side, which is great to see. So I don't think, the point I want to make here is that it's not all a negative story in the fund sector at the moment. There is a large degree of positivity out there, which is great and reassuring.
I think that's important to touch on as well, is staying positive and seeing that positivity and seeing progress and development and moving forward. And John, I was asking Oliver as well as Paul, and if you want to touch base on just from the operations compliance side of things for managers that are either launching or in existence, what can they be doing to have a plan in place moving forward, that will give reassurance to investors and build that confidence and trust within their LPs?
Sure. So when it comes to existing funds with existing LPs, we've touched quite a bit on that. When it comes to new launches, like Oliver said, there are funds being launched. We've had a wave of new long-short equity hedge funds and various sector-focused funds that are preparing that launch. And this time around, with that, although they're moving hastily to get their documents set up and get their governing documents ironed out, there's going to be more of a focus on the compliance at an enterprise level and making sure that the communications, as I mentioned before, are shared across the board. Now, with private equity and other closed-end funds, the iterative process of preparing pre-launch term sheet circulation, identifying potential investors, securing soft commitments, that has been quite light in terms of legal documentation. A lot of times funds will do that while attaching a string of disclaimers, and that's really not sufficient. It hasn't been for private equity, and for liquid funds, certainly that is the case because the subscriptions come in contributed versus committed. And so what we're seeing and what we're recommending is in that pre-launch period that the clients are preparing short form offering documents or pre-launch disclosure documents that are accompanying any term sheet or other circulated material prior to launch. And then with that, a consistent infrastructure that once the fund does launch, once the fund is fully formed and operational, that launch date, start date can be triggered and move forward with all of the planning in place, with all the infrastructure in place, rather than laying out full documentation and then beginning the capital raise.
And along those lines, while I have you, and then I think this is an important one to open up to the other panelists as well, for the capital raising, it's almost a little bit of an awkward conversation for, some managers, because there is so much uncertainty, but this is also their livelihood, and they, they're gearing up, they're ready to go, and they need to start raising capital. Should they be approaching their fundraising strategy differently, or their capital raising approach, for investors? How should they be approaching it in this climate from what, you've seen in 2008 and now? What are your thoughts on that?
Yeah, I think the one factor, and many of the panelists and commentators globally have discussed, is that when approaching potential investors in a way that's going to put them on their heels in this type of climate is not appropriate, and that the strategy needs to be different in this climate. And one approach that we've seen effectively deployed and that we've advised on is to establish a anticipated present intent launch date for a fund, and have discussions with investors that are based on not a current offering to subscribe now, but as a indication of interest for a future launch that's anticipated, of which the investor may or may not have the opportunity, and it provides that degree of deference to the future of the market. And the big benefit there also is it provides the manager the ability to further refine the strategy, and that can be done in a compliant way, so long as we're properly documenting that this is a to be launched fund, and that it has current truncated risk factors, disclosures, bios, investment strategies, and that these are contingent on a forthcoming offering document. And that provides a bit of a layer of separation between an immediate
Well, it looks like we may have lost John for a minute, but if
Jen, can I just
yeah.
jump in there? There is absolutely nothing, as John said, there's nothing to stop you from having a very broad investment strategy and indeed having the ability to amend your investment strategy as and when the circumstances arise and the directors deem fit. So that's another thing that we can bring in to funds that haven't launched yet, that are in the process of launching, and we're drafting their PPMs, just a broader discretion regarding investment strategies and the ability to pivot effectively given market circumstances.
And
the other thing I wanted to just touch upon very quickly is, going back to the operational point, is that emerging managers don't generally have independent directors, but it occurred to me, and there's an obvious reason for that because they are obviously an additional cost. That said, given the circumstances, it occurs to me that this may be a prime time to get an independent director or multiple independent directors on the board who are real veterans, who have seen the 2008 crisis, who have gone through it, that you as a manager can then rely upon their experience and wisdom.
And I think that's a good point to talk on. And you mentioned the cost, and I think that goes into the capital raising is if you don't feel comfortable that you can maintain operational costs for what you may need moving forward at this point, that's something to also consider on when you're going to plan your launch. And I know we have John back on, and I just want to clarify, John, with you, we're still seeing quite a bit of activity in fund launches, but those funds have those pre-identified investors that have been, there for a while, and they've really thought this out and have a plan. And I think, more what you're referencing in terms of anticipated fund is for those launches that don't have that confidence of a certain AUM at start. Is that correct?
Right. What I'm looking at is investor managers that are contemplating launching a fund, not because they have been in the process, but that are now looking at climate shifts for liquid long funds specifically. We've had a lot of activity. We had a tremendous volume of calls looking at launching, and our concern is just that to raise a limited amount of capital from a close group is certainly possible, but to scale that is going to be challenging, and this timing may not be perfect for what they're doing unless they have a strong full capital raising strategy, and that can be developed, but should be done with an iterative process. But certainly with funds that are prepared in the process and are ready to launch with an investor base, that they should be proceeding as usual, except with a particular focus on disclosure, compliance, getting offering documents that are very robust, and proceed accordingly. And I apologize. I actually keep losing connection here. I am in the city of New Canaan, Connecticut, with a population that is no longer commuting, and the infrastructure of this town was not intended for whole groups of people browsing the internet at the same time, I guess. So I'll try to monitor that.
I would add that certain strategies thrive once the dust settles on a down market. Distressed strategies are certainly going to come into favor. But indeed, as someone quite pointedly, articulated quite well earlier in the call, there are certain people that just don't want to hear a sales pitch right now for anything at all. So, it really EQ comes into place at this time, and process. People want to know that you as a manager are process driven and focused, and perhaps cost focused as well. Sometimes outsourcing comes into play at times like this. But indeed, just in light of costs or concerns around that. But indeed, some strategies are just going to be, not in favor at this time. And given that many people just incurred losses, the sensitivity around what people want to hear and how they want to hear it is absolutely critical to being a leading GP at this time. And it's also important to note that the increased reporting regime that we're all part of now started in the previous crisis when investors wanted more information about what they had put their money in. So,
Yeah.
I think that, that's probably only going to continue to become more of a demand from the LP community, whether it be an existing LP or a prospective LP. And, this has been an exciting month for everyone. It could be that a slight pause in your effort to push something forward would be very wise. But it really depends on what you're pushing forward. Some people do have needs right now, and indeed, at some point, the LP community will be looking to recoup losses or to get to invest in a strategy that is doing well during a tough time.
Agreed. And Arthur,
and one thing.
Go ahead.
So one thing I wanted to add is when you talk about the process-driven strategies. From the legal side and from the term setting and negotiation side, the market standard is really driven by the economics of the LPGP relationship, and as we saw with open-end funds, the shift in terms went in favor of the investor direction, and in private equity, we've seen shifts going towards the managers because of the demand. And so when speaking to legal counsel about what is market, what is standard, and we're heavily driven by those processes, those can get in the way because the investment terms and the market standards are going to be shifting, and it's critical that in that investment term setting process, side letter process, that there is a revisiting of templates, not just disclosure, but investment terms, and in watching to see what those terms should be, and certainly anticipate additional shifts, particularly in the transparency side.
Perfect. Thank you. And I wanted to just ask Arthur a quick question before I switch gears and chat with Paul for a little bit just on the fund insurance, because I find that aspect really interesting and important. But with Arthur, from the investor's perspective, what plans do you have in place or during situations like this, and what are you preparing for, or your managers that are helping you, what type of plan do you have from the investor's side during this time?
So I can only comment on my situation, which I might be able to comment on what others might be thinking, but in my situation, I've been very fortunate in that more or less everything is in good order. And the only thing I've liquidated is some public securities that were not in a fund. And I will admit that it was a bit emotional, but for the time being, I made the good call. But this is not a very good answer, and so you can yell at me for it, but we're just taking it day by day. and just paying attention to what the managers are saying, looking at what's going on in the markets and what's happening with the global crisis and the virus, and just inch by inch, and not making any rash decisions, but doing the best we can to pay attention to a number of data points. And I will admit, I have no idea what the right thing to do is.
And I fully agree. I think that day by day is the way I think a lot of people are taking this. But from investment management perspective, it's really thinking ahead, forward thinking, always planning. We always said in law enforcement, if you stay prepared, you don't have to get prepared. And I think, Paul, switching gears to you, because it is really relevant that, I personally always think that, any fund manager coming along should have a conversation, with a fund insurance provider, just because it's not something you might think of having that conversation with, such as some of, those standards that you need for a fund. But what type of, when it comes to insurance, how does one prepare for this, or what conversations should they be having moving forward? Maybe not at this point because we're in it, but for the future, just like in 2008, but now, from your perspective in fund insurance, really, what should managers be thinking about?
Thanks, Jen. Well, there's a couple of things. The professional lines that we supply to our clients, the so-called E&O, D&O, can deal with investor claims against the manager for, at the end of the day, probably bad performance, although the indemnifications prevent your LPs from bringing suit, but they will backdoor those types of claims with gross negligence, bad faith, strategy drift, all kinds of things that are allowed to be brought forth. And as the market declines, if it does continue to decline and people find themselves with less liquidity, they're going to try and find liquidity wherever they can. A lot of what's going on in the market today is talking about business interruption, and I'll get to that in a second. John and I have had discussions about pre-launch disclosures and discussions between potential investors and emerging managers that may happen even prior to the official launch or prior to having counsel fully vet your offering documents. E&O, D&O coverage can defend a manager against those type of claims also. Regulatory protections are a hallmark of these policies. In terms of business interruption, it's a difficult question because it's really designed as a property loss. It kind of fits into the model more of a restaurant or a retail store where some physical damage to that property, let's say it's a fire, prevents that business owner from transacting business in that location. That's your classic business interruption. In a fund scenario, most funds are able to operate remotely, and the physical location is not really what drives the revenue. So funds can exist outside of their mailing address or their business address for some time without the need to actually have a physical demise space. So the business interruption becomes difficult because did the fund lose money as a result of something happening to their physical structure? Probably not. However, you're seeing a lot of potential legislative remedies happening right now where Congress is in discussions with the insurance industry to primarily deal with the tens of thousands of small businesses in the country that rely on traffic that don't, that aren't getting the traffic. Now, so we may see that New Jersey is trying to mandate these. Now, the insurance industry is going to push back against that because these policies were never designed for these types of losses. A lot of policies will have infectious disease or pandemic exclusions. They may be silent on that, but again, that was not intended to be part of the coverage scenario in these policies. There may be,
go ahead.
There may be some civil authority protections that are built in, that if the government comes in and physically closes down your site for whatever reason, perhaps there was, staff that was coming down with the virus, and the government stepped in and said, your physical location has to close because we have to kind of get to the root of that. So there's potential there. There's also something called preservation of property. If there's some imminent threat to your policy, there could be coverages there. But this is uncharted territory. There is some pandemic type coverage that's available through the Lloyd's markets that are designed for hospitality, the travel industry, aviation, public entity, and things like that, not necessarily in the financial institution sector, because physical traffic to a physical location is not generally required, and business interruption would kind of indicate that there was some sort of loss due to, a physical threat to property.
And do you see potentially the insurance sector reassessing, adding that in, not necessarily potentially as an exclusion, once maybe the dust settles and we were able to see really what the impact has been to the financial institution market? Is that something, a discussion potentially you think that might take place?
Well, I think, we could look back to 9/11 as a potential blueprint for this kind of coverage. Prior to September 11, 2001, there was really no such thing as a terrorism exclusion. So I think the knee-jerk reaction may be in policies that don't have infectious disease or pandemic kind of exclusions to put those in. Congress responded with something called the Terrorist Risk Insurance Act, which came out, I believe, in 2009 initially, that basically said the government will be able to backstop these kinds of losses. So I think that government working with the insurance industry will put something in place where there'll be certain buybacks for this kind of coverage, and probably provide clearer coverage in a situation like we find ourselves, where whole states are mandating folks, shelter in place, and whole businesses, sectors are closing because of it. Again, a business interruption loss, has to basically be a function of lost income. Negative performance would not be considered lost income in the fund management realm. But I do see, certainly something coming out of this. This is being highlighted in many state and federal realm, with Congress trying to figure out how to protect small businesses that have been impacted by something like this. And, you listen to the health experts, this is certainly not an isolated, although they're calling it a novel coronavirus. I think we're going to see more of these going forward, and businesses are going to be looking towards some way to protect themselves from future outbreaks.
Absolutely. And I don't know if any of the other panelists have anything to add to those comments from Paul, but if so, please feel free. And moving forward and just, kind of wrapping that conversation up, Paul, is the internal side of things, the operations side of things, from an insurance perspective, and managers putting in those precautions for their employees and their business, taking time off from work and not having their internal network or their team fully accessible and able to help. I mean, I can only imagine that's a potential loss or a potential liability to their welfare of their firm.
Well, I'm reading in this environment, obviously, any sort of weaknesses in your data systems are subject to hacking, and certainly the hackers are out in full force. So there is some potential business interruption coverage available if there's a cyber breach, let's say that, or a contingent business interruption loss. Let's say that a firm's trading platform is brought down and they cannot trade because there was a denial of service attack. There's potential for business interruption there, but it's important to note that business interruption is a stated value, a stated limit. So let's say you have a $10 million limit, cyber limit with BI of 10 million. The most that you could recover, regardless of what your loss would be a full limit loss of $10 million or 1 million or 3 million. So these coverages are becoming, much more intertwined. In terms of employees that find themselves ill or sick, those are probably going to be, at least at first, workers' comp claims. I think there was a question that went around, what if an employer, demands that employees come to work in opposition to work from home mandates? There is a provision in the work comp law for employers' liability for extreme situations. Generally, an employee cannot sue an employer for getting sick or getting a disease or getting injured unless that employer was grossly negligent. So something like that could happen. The industry is gearing up. I know in our own firm we have claims advocates and attorneys on staff that are waiting for a deluge of coronavirus type claims. And until those actually hit the insurance companies, we're not going to know exactly the kind of position. The New York State Department of Financial Services came out with a mandate earlier this month that said property insurers need to publicly declare what their BI coverage positions are. I have yet to see one property carrier make that publicly known where their position is going to be. And I have made several requests from several of them. Most of the underwriting community has not heard this. So it's going to be interesting to see what happens in the weeks and months that move forward, in terms of where claims happen or are trying to be denied. It's, I think, a fair statement to say that the insurance industry did not build this into their underwriting models, which means that they did not collect premium for these kinds of losses. So any sort of jump in claims payouts, whether it's legislatively demanded or not, will certainly probably drive up the premium, going forward for property coverages and potentially cyber coverages and things like that. The pandemic kind of risk that we're seeing in specialized sectors that's written outside the U.S. through Lloyd's syndicates, I think you may see that broadening, as this is certainly not like anything we've ever seen before.
Absolutely, I agree, and thank you so much for that. And most of the questions that we've received, looks like we've covered. There were a couple of specific ones and that were provided in the registration, and we'll reach out, I think, personally to get those answered. But I think we're pushing an hour and a half, and there was so much content we have to cover. We probably could go for another hour, but I know everybody's time is very valuable. I just want to ask any of our panelists if they have any final thoughts that they'd like to share. Oliver, Arthur, John, Nancy, and Paul.
This is Paul. Jen and John, this is such a unusual situation. We may want to come back, on 30 days and see where this thing plays out. It's supposed to be a 14-day, shelter in place, see what happens. Let's see if the market recovers. This may be something that requires, continued focus and continued thought on our parts.
Oliver, do you have anything you'd like to add with that?
No, I mean, I agree. I think my favorite comment of the day actually was I think it was by Arthur, which is take things day by day. No one knows what the right thing is to do right now. Indeed, frankly, I don't think there is a right answer. And from my legal perspective, no regulator is going to object if you take a reasonable, rational decision / step right now, which is well documented. I think that is key from my perspective right now, is just act reasonably, rationally, and make sure that everything is clearly documented somewhere. And hopefully everyone will be able to weather the storm.
Yes, and with that, it's, you have a team of providers, as managers and investors, and you're paying that team for a reason, and you hired them for a reason. And I know everybody on the panel would agree to reach out, ask a question. We might not have the answers, but we're here to talk you through it and do what we can from all of our sides, as well as I'm sure, your providers that our audience might have from all sectors. Arthur and John and Nancy. Arthur, if you want to give any final comments.
Thank you, Jen. I didn't properly thank you for including me, and thank you for doing that. And
well, you're off my Christmas list now.
Oh, I can't wait. I'm Jewish.
No Hanukkah for you.
Yeah, I'm not really Jewish. I'm going to say this, it may not be appropriate for everybody's listening in, but if you think it's appropriate, because it was super instructive for me to hear everything that was said on this call, and that's not hyperbole. I'd be glad. There's 22,000 people that have subscribed to one way or another to Family Office Insights. And I'd be my pleasure to socialize this recording or any way you want, because I think it would be, and the audience is 5,000 family offices, and the rest of the people are the people trying to get to the family offices. So I think there's a good cross section of people that would be interested in hearing this, independent of having been on the call. So you can think about that, but it'd be my pleasure to do that.
Thank you. Absolutely. I think that if it's information that can be helpful, that's been our purpose, and we'd love to make that available for anybody that wants to view it, and we will on our website, and we'll share it with the other panelists to circulate if they'd like. Nancy, do you have any final thoughts that you want to share?
Yeah, sure. Just another big thank you to the Capital Fund Law Group for putting this together. Indeed, this is an unprecedented time, and stepping out and providing thought leadership is what is in order, even if you don't have every answer. And indeed, I think an honesty around having every answer or not having every answer is welcome at this time. Yeah, I think, once again, to reiterate, I think calm, process-oriented functions that you can iterate to your investor base and to your clientele are what is in order right now. Indeed, when difficult times occur, people tend to think everything is over, and indeed it's not. I think we've all been through some challenges on the business cycle, and indeed running succinct businesses is all about weathering uncertainty with leadership and with forethought. So I think the calm process orientation, a consideration around costs, and a real honesty about what you're seeing out there is what LPs call for, and indeed clients call for at this time. Thanks again, Jen and John.
Absolutely, thank you. And Paul, I know we just ended on you in the discussion, but if you have any final thoughts, I'd love to hear them.
Basically, insurance contracts are very complex, and carriers offer different things. Have a qualified broker look through your policy if you have questions or you believe that you have a claim. We are certainly open on our team to look at these kinds of things, but there are lots and lots of different nuances that your fund manager clients may or may not be available, and there could be some protections that are offered, to respond to certain losses in this difficult time.
Perfect. And I'll just wrap up my portion, and then I will just let John close out the webcast. But we will be circulating the post attendee email. It will have everybody's information in it. Please feel free to reach out to them or to myself if you have follow-up questions, and I can direct it to who may be best suited to potentially answer those. Those that haven't been addressed, like I mentioned, we will get those questions out to you. I have your contact information, and from me, I just want to thank everybody for attending, and just a huge thank you. Last minute notice for all of our speakers. You were wonderful and accommodating, and we couldn't have asked for a better, more knowledgeable panel. So thank you so much for making this easy for me. And with that, I'll let John just wrap this up briefly.
Well, thank you. And I think everything has been summed up well. I think there's a shared philosophy among those of the panelists, and no doubt those that are on the call, that we're focusing on integrity and focusing on placing investor interests first, and looking at manager interests within the relationship of a fiduciary. And to the extent that difficult circumstances test our integrity, that is a time for planning and processing, and being explicit about where those conflicts of interest could lie, and making sure that in our discussions we're not subverting the explication of our own interests ahead of those of the managers, and really appreciate the discussion here. And usually when you get panels together, we're panels of experts. In this case, we're all trying to figure this out together, and there are different aspects that different groups can share, and I'm sure there are various other facets and layers that can be brought in by different groups and thoughts when it's centered on the betterment of the community, and ultimately the protection of the investors. And I thank everyone for joining, and be safe out there, and enjoy the time with your family.
Perfect. Thank you,
You all
everybody.
did the same.
Take care.
Thanks, John. Bye-bye.